Greetings to all our IMAPS clients and investors. Let me walk you through the latest changes to the IMAPS conservative portfolio made during the first week of January. The last quarter of 2023 was by far the strongest for the year, and it broadened the rally to include other asset classes that had hitherto been excluded. Resilient economic data, along with central banks insinuating the end of the interest rate hike cycle, fueled a cross-asset bonanza where soft economic landing, a slowdown without a recession, became a plausible reality. Our 2024 baseline forecast assumes gentle economic deceleration and rate cuts later this year, providing a sanguine outlook for fixed income and equities. Nonetheless, we remain a bit more cautious than the broader investor community, positioning our portfolios to withstand downside economic surprises. Cash, equity, and fixed income allocations were adjusted versus the benchmark to neutral from underweight to participate in the benign market momentum without taking excessive risk. Cash was exchanged for bonds to lock a higher overall average interest rate level. The US equity part of the portfolio has seen an increase in the large cap growth versus blend and value to better follow the expected economic soft landing and future rate cuts, closely tracking the benchmark. Equity regional allocation has remained unchanged and in line with the benchmark. We have expanded the investment-grade fixed income portion of the portfolio to increase exposure to pure interest rate risk as the most likely fixed income source of returns in 2024. In parallel, exposure to high yield was reduced to minimize credit risk given the current low spread risk premium paid by the market, capping downside risk in case of unexpected negative market surprises. Chinese idiosyncratic risk remains a source of unexpected events, negatively skewing the risk-reward profile of the portfolio. Chinese government bonds have provided excellent returns in the past. Nevertheless, we have rotated into US Treasuries to profit from the more attractive relative terms and lower idiosyncratic risk. Finally, we have kept the duration of the portfolio fairly constant and along with the benchmark to share the expected easing in monetary policy without introducing excessive volatility in the portfolio. We hope you are well, and as always, please reach out to your financial advisor or investment professional with any questions you may have. Thank you.
Insigneo Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insigneo International Financial Services, LLC, headquartered in Puerto Rico, and through Insigneo Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insigneo Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insigneo International Asesores de Inversión Uruguay, SA, Insigneo Asesores de Inversión Latam, SRL, and Insigneo Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insigneo Argentina, SAU, and in Chile through Insigneo Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insigneo Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insigneo.com/disclosures/ or via www.finra.org. To learn about Insigneo Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.